The trading window is closed. Again! And employees are frustrated. It really makes you wonder, are your trading windows too restrictive? Or are your practices aligned with what other companies do? Let's take a look at the most recent data on this from the NASPP Deloitte Equity Administration Survey. It should come as no surprise that the employees who are most often subject to trading windows are your named executive officers, other senior executives, and, of course, employees who have access to material non-public information. But when it comes to the rest of your employee population, well, size matters. Companies with fewer employees are more likely to extend their trading window restrictions down lower into the organization, oftentimes all the way out to their general workforce. And this makes a certain amount of sense to me. Companies with fewer employees tend to share information more broadly among their employee population. And of course, if we're a smaller company, then the contributions of any one employee or any one department likely have a bigger impact on our overall financial results. We see the same trend when it comes to outside directors. Companies with fewer employees are more likely to extend their trading windows to their outside directors. Close to 90% of companies close their trading window before the end of their fiscal quarter. How far before? Well, that varies pretty considerably, anywhere from 11 days to there's a good percentage of companies that close that window more than 25 days before the end of the quarter. Once earnings are announced, however, most companies are pretty quick to reopen the window. Close to 80% of companies will reopen that window within 2 days after earnings are released. Open market sales are universally prohibited during a closed trading window. And that goes for sales that are in connection with equity plan transactions as well, like same-day sale exercises of stock options and shares that are sold that were acquired under RSUs or under the ESPP. But other types of equity plan transactions that don't involve an open market sale sometimes are permitted during a closed trading window. For example, half of companies allow cash exercises during their closed trading window, and almost 2/3 allow share withholding to cover taxes on RSUs. It is also quite common for companies to allow enrollment in their ESPP and changes in contribution rates to their ESPP during a closed window. So what's not allowed? Gifts. Only 19% of companies allow gifts of stock during a closed trading window. So now I hope you have a better idea of how your trading windows compare to your peers. All of the data that I present here today is from the 2025 Equity Administration Survey, which is administered by the NASPP and Deloitte Tax. If you're interested in more results from the survey, we'll include a link in the show notes. I hope you enjoyed my video today. If you did, hey, why not share it on LinkedIn? Maybe some of your LinkedIn connections would enjoy it too. And those shares really help us out. Win-win. Thanks for watching.